put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. How one man crashed global markets. March 26th, 2021. A Friday afternoon. While most of Wall Street prepared for the weekend, something catastrophic was unfolding in the shadows of the financial system. Within hours, over $100 billion in market value would evaporate. Banks across 3 continents would sustain losses so severe that careers would end, boardrooms would panic, and regulators would scramble to understand what had just detonated beneath their feet. But here's what made this collapse different. What made it terrifying. Almost nobody saw it coming, because the man at the center of this catastrophe had been invisible. His name was Bill Hwang, and he had built a financial empire so secretive, so leveraged, so dangerously concealed, that when it collapsed, it took down some of the world's most powerful banks with it. This is the story of how one man, operating from a modest office with a Bible on his desk, manipulated billions in borrowed money to play God in the stock market, and how his divine ambition turned into Wall Street's worst nightmare. Bill Hwang wasn't supposed to be a threat to the global financial system. In fact, by 2021, most of Wall Street had forgotten about him entirely. He ran what appeared to be a small family office in New Jersey, Archegos Capital Management, managing what he claimed was his own personal wealth. No outside investors, no public filings, no scrutiny, just a deeply religious former hedge fund manager who had already been banned from trading in Hong Kong after pleading guilty to wire fraud in 2012. A man who should have been chastened, humbled, relegated to the margins of finance. Instead, he was quietly building one of the most concentrated, most leveraged, most dangerous positions the modern market had ever seen. And the world's biggest banks were his willing accomplices. The brilliance of Hwang's scheme wasn't just the scale, it was the invisibility. Family offices, unlike hedge funds, operate in regulatory darkness. They don't have to disclose their holdings. They don't have to register with the SEC. They exist in the shadows, managing private wealth away from public eyes. Hwang exploited this obscurity with surgical precision through instruments called total return swaps, derivatives that allowed him to control massive stock positions without actually owning the shares. He amassed exposure to companies like Viacom CBS, Discovery, Baidu, and Tencent Music that exceeded 50% of their entire trading volume. He wasn't just betting on these stocks. He was the market. And because of the swap structure, his name appeared nowhere. The banks, Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, Deutsche Bank, were technically the owners of record. They were the front, the camouflage. But here's where the darkness deepens. Each bank believed it was Hwang's primary broker. Each thought they understood his full exposure. None of them knew he was playing them against each other, borrowing from all of them simultaneously to build positions so concentrated that a single wrong move could trigger catastrophe. Credit Suisse alone had extended him over $20 billion in leverage. Nomura had lent billions more. The leverage ratio was staggering. Estimates suggest Archegos controlled between $50 billion and $100 billion in total positions, with perhaps only $10 billion in actual capital. That's 5-to-1, maybe 10-to-1 leverage on a portfolio built on borrowed money and derivative smoke. One banker would later describe it as a loaded gun pointed at the entire system, and we were all holding it without knowing who else had their finger on the trigger. Hwang's strategy was deceptively simple. Buy stocks, use the gains as collateral to borrow more money, buy more of the same stocks, repeat. As the stocks rose, driven partly by his own massive buying, his positions grew larger, his leverage increased, and his phantom empire expanded. It was a perpetual motion machine of risk, lubricated by greed and enabled by banks that asked too few questions because the fees were too lucrative. Hwang's trading generated hundreds of millions in revenue for these institutions. They competed for his business. They relaxed risk controls. They let him gorge on leverage because, in their calculations, Bill Hwang was a sophisticated investor who knew what he was doing. They were catastrophically wrong. March 22, 2021. 4 days before the implosion, Viacom CBS announced a $3 billion stock offering, a routine capital raise that should have been a non-event. But for Archegos, it was a death sentence. The sudden influx of new shares diluted existing positions, and Viacom CBS stock began to fall. For most investors, a 9% drop would be painful, but manageable. For Bill Hwang, who had borrowed billions to concentrate his entire portfolio in a handful of stocks, a 9% drop was apocalyptic. Because when your leverage is 5-to-1 or 10-to-1, a 10% loss doesn't just wipe out 10% of your wealth. It threatens to wipe out everything. The margin calls came fast. Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley. They all demanded more collateral to cover the losses. Hwang scrambled to meet them, but the hole was too deep, the leverage too extreme. And then came the realization that would send shockwaves through every trading floor in the world. Bill Hwang couldn't pay. What happened next was financial carnage disguised as orderly liquidation. On Friday, March 26th, the banks moved simultaneously to dump Archegos' positions before the market realized what was happening. Morgan Stanley and Goldman Sachs acted with ruthless efficiency, selling billions in blocks without public disclosure, minimizing their losses. But Credit Suisse and Nomura hesitated, clinging to hope that somehow the positions could be salvaged, that Hwang might find the money, that the market might recover. That hope cost them everything. By Monday morning, the stocks Archegos had inflated, Viacom, CBS, Discovery, Baidu, were in freefall. Discovery dropped 27% in a single day. Viacom CBS plunged 23%. The forced selling triggered a cascade that dragged down entire sectors. Credit Suisse would ultimately lose $5.5 billion. Nomura would lose $2.9 billion. Careers ended. Bonuses evaporated. And the question everyone was asking, how did one family office blow up half of Wall Street? The answer lies in a toxic cocktail of regulatory failure, institutional greed, and one man's pathological belief in his own infallibility. Bill Hwang wasn't just a trader. He was a zealot. A former protege of Julian Robertson's Tiger Management, Hwang had started his own hedge fund, Tiger Asia, in 2001. He made billions betting on Asian stocks, but his methods were darker than his investors knew. In 2012, Hong Kong regulators accused Tiger Asia of insider trading and market manipulation. Hwang settled with U.S. authorities, pleading guilty to wire fraud and paying $44 million in fines. He was banned from trading in Hong Kong for 4 years. Most money managers would have retired, chastened by scandal and regulatory exile. Not Hwang. He converted Tiger Asia into a family office, named it Archegos, a Greek word meaning one who goes first, a biblical reference to Christ leading the way, and convinced himself that his losses, his legal troubles, his ban from Hong Kong were all tests of faith. God, he believed, wanted him to continue. And continue he did, with even more leverage, even more concentration, even more risk. The theological dimension of Hwang's trading is impossible to ignore and deeply unsettling. He was known to begin meetings with prayer. His office featured biblical verses. He donated hundreds of millions to Christian causes, seeing his wealth as a divine mandate to spread faith. But beneath the religious facade was a man addicted to risk, convinced that his success was God's blessing and his failures were merely temporary setbacks designed to strengthen his resolve. This combination, messianic confidence and financial recklessness, is a recurring pattern in market disasters. It's the same psychology that drove long-term capital management, Lehman Brothers, Bernie Madoff. The belief that you are special, that the rules don't apply, that you can see what others cannot. Hwang's faith made him dangerous, not because he was religious, but because it immunized him against doubt. Every margin call was a test. Every warning was noise. Every risk was justified by the conviction that he was on a mission. And the banks? They enabled him every step of the way. The prime brokerage business, lending money to hedge funds and family offices for trading, is ferociously competitive. Margins are thin, and the real money comes from volume. Banks courted Hwang because his trades generated massive fees. They knew he was leveraged. They knew his positions were concentrated. They knew he had a criminal record. But the revenue was too tempting. And the belief that they could manage the risk, that they were sophisticated enough to monitor exposure, that they had the models and the controls, proved catastrophically misplaced. Worse, the total return swap structure meant that banks weren't just lending money. They were actively hiding Hwang's positions from the market. Because the banks held the shares on their own books, Hwang's massive stakes never appeared in public filings. The SEC, other investors, even other banks had no idea how concentrated his positions were. The system designed to prevent another 2008. Transparency, oversight, risk management had been gamed by a structure that let one man control billions in the shadows. But here's the truly terrifying part, the layer of this story that still haunts regulators and risk managers. Archegos wasn't unique. The structure Hwang exploited, family offices using swaps to build hidden leveraged positions, is everywhere. After Archegos collapsed, regulators began asking a question that Wall Street didn't want to answer. How many other Bill Hwangs are out there? How many other family offices are sitting on leveraged time bombs, invisible to regulators, unknown to markets, enabled by banks desperate for fees? The answer is, nobody knows, because family offices still don't have to disclose their holdings. The loophole Hwang exploited remains wide open. Estimates suggest there are over 10,000 family offices globally, managing trillions in assets, and the vast majority operate in complete secrecy. Some are conservative, prudent, boring. But others, the ones chasing returns, the ones using leverage, the ones playing with derivatives, are invisible threats embedded in the market, like financial landmines. The regulatory response to Archegos has been predictably toothless. The SEC issued warnings. Congressional hearings were held. Banks promised to improve risk management. But the fundamental structure, the ability of family offices to operate in secrecy, the use of swaps to hide positions, the willingness of banks to extend limitless leverage for fees, remains unchanged. Why? Because the people who would need to change the rules are the same people who profit from the current system. Wall Street banks make billions from prime brokerage. Family offices, often controlled by billionaires with political influence, have no interest in transparency. And regulators, perpetually understaffed and outgunned, lack the resources and political will to force disclosure. So the game continues. Somewhere, right now, another Bill Hwang is building another Archegos, borrowing billions, concentrating positions, hiding behind swaps and family office secrecy. And when it collapses, because it will collapse, leverage always collapses eventually, we'll have the same hearings, the same promises, the same cycle of crisis and inaction. In the aftermath of the Archegos disaster, Credit Suisse's leadership tried to contain the damage. The CEO resigned. The head of investment banking was fired. Risk officers were scapegoated. But internal reports revealed something more disturbing than incompetence: willful blindness. Credit Suisse's risk committee had flagged Hwang's positions as dangerous months before the collapse. They recommended reducing exposure. Senior management overruled them because Hwang was too profitable to lose. It wasn't that the bank didn't know, it's that they didn't care. The fees, the revenue, the competition with other banks, all of it overrode basic risk management. This is the rot at the heart of modern finance. The certainty that when things go wrong, someone else will pay. Credit Suisse lost billions, but they didn't fail. Shareholders absorbed the losses. Taxpayers didn't have to bail them out this time, but the precedent remains. If you're big enough, reckless enough, connected enough, the system will find a way to keep you alive. Bill Hwang himself has remained largely silent since the collapse. In April 2022, federal prosecutors indicted him on charges of racketeering, fraud, and market manipulation. The indictment alleges that Hwang and his top lieutenant orchestrated a scheme to manipulate stock prices, lie to banks about Archegos' positions, and defraud investors out of billions. Hwang pleaded not guilty, and his trial is ongoing, with his lawyers arguing that he was simply an aggressive investor, not a criminal. But the evidence is damning. Recorded calls where Archegos traders discuss hiding positions, internal documents showing deliberate misrepresentations to banks, patterns of trading designed to artificially inflate stock prices. If convicted, Hwang faces decades in prison. But even if he goes to jail, the system that enabled him, the banks, the regulators, the loopholes, will remain intact, ready to create the next disaster. The human cost of Archegos extends beyond bank balance sheets. Thousands of employees at Credit Suisse saw bonuses slashed or eliminated because of losses they had nothing to do with. Shareholders of Viacom, CBS, and Discovery watched their investments crater, not because of company performance, but because one man's leveraged bets unwound in a forced liquidation. Pension funds, retirement accounts, ordinary investors, they all suffered collateral damage from a scheme they never knew existed. This is the nature of systemic risk in modern markets. It's invisible until it explodes. And when it does, the people who caused it are often shielded, while everyone else pays the price. Hwang's philanthropy, his hundreds of millions donated to churches and Christian organizations, now looks different in retrospect. Was it genuine faith, or the guilt-driven largesse of a man who knew, on some level, that his wealth was built on a foundation of fraud and recklessness? We may never know, but the pattern is familiar. Robber barons building libraries, billionaires pledging their fortunes after extracting them through exploitation, wealth laundered through charity to buy redemption. The most chilling lesson from Archegos isn't about Bill Hwang, it's about the system that allowed him to operate. Every safeguard failed. Regulatory oversight failed, because family offices exist in a disclosure vacuum. Bank risk management failed, because profit motives overrode caution. Market transparency failed, because swaps hid the positions from public view. This wasn't a black swan event, some unforeseeable catastrophe that no one could have predicted. It was a white swan, visible to anyone who cared to look, ignored by everyone with the power to stop it, because stopping it would have cost them money. The 2008 financial crisis was supposed to teach us that excessive leverage, hidden risks, and institutional conflicts of interest lead to disaster. Dodd-Frank, stress tests, capital requirements, all of it was meant to prevent another collapse. But Archegos proved that the lesson was never learned, or if it was learned, it was deliberately forgotten as soon as the memory of crisis faded and the profits returned. As Bill Hwang's trial unfolds, as regulators issue reports, as banks claim they've learned their lessons, the fundamental truth remains. The machinery that creates financial disasters is still running. Somewhere, in a quiet office, a trader is building the next over-leveraged position. A bank is extending credit it shouldn't, chasing fees it can't resist. A family office is using swaps to hide exposure that will one day come screaming into the light. And when it does, we'll act shocked, we'll demand accountability, we'll promise reform. And then the cycle will repeat, because the system is designed not to prevent disasters, but to profit from them, right up until the moment they explode. March 26th, 2021. The day Bill Hwang's empire collapsed and took $100 billion of market value with it. But here's what keeps the professionals awake at night, what makes risk managers check their portfolios twice before going home. Archegos wasn't the end of something. It was a preview, a warning shot from a system overloaded with hidden leverage, invisible positions, and institutions that have learned nothing from history except how to hide their risks better. Bill Hwang believed he was chosen, that God had blessed his trading, that faith and leverage could move mountains. He was wrong, but the banks that enabled him, the regulators that failed to stop him, the system that allowed him to build a $100 billion time bomb in complete secrecy, they're all still here, still operating, still waiting for the next man who believes he's invincible. And when that next collapse comes, when the next invisible empire crumbles and drags the market down with it, we'll ask the same questions we always ask. How did this happen? Who could have known? How do we prevent it next time? The answers are already visible, written in the wreckage of Archegos capital. We just choose not to look. Subscribe and listen to our next story below.